Hi, welcome back to Chapter 8. In this video lecture, we will discuss units of production method to calculate depreciation expense. This is brand new to you. You've not had units of production depreciation in prior chapters. It is discussed in Chapter 8 on pages 307 and 308 of your textbook. It's very similar in calculation to straight line depreciation. The formula for units of production is cost minus salvage value divided by expected units. Straight line is cost minus salvage value divided by expected life. So it's quite similar in its calculation. Example, on March 8th, 20X1, we purchased a truck for $53,000 with an expected useful life of 5 years, over which time management estimates that the truck will be driven for 192,000 miles. The truck is expected to be sold at the end of 5 years for $5,000, and the truck is used 100% for business. Calculate the estimated depreciation expense per mile. We'll use this formula. Cost minus salvage value divided by expected units produced, which would be, in this case, expected miles driven. Please do that calculation, then come back and see if your solution matches my solution. Did you get 25 cents per mile? Cost of $53,000 minus $5,000 of salvage value divided by 192,000 expected miles equals 25 cents per mile. As time goes on, we can actually take the odometer readings. Now, sitting at December 31st, 2000 X1, we do not know what the miles driven on the truck were for these future years. So what we did was we took the odometer mileage at the end of each of these years and calculated the miles driven each year. So I can show you all the miles driven during those years. The depreciation expense is really easy to calculate. Total miles driven in X1 were 32,500. That comes from right here. What's the depreciation rate per mile? 25 cents per mile. Therefore, depreciation expense for year 1 is the actual miles driven times the rate per mile, $8,125. From the straight line problem, you know that accumulated depreciation is 8,125 at the end of the first year, and book value is the $53,000 of cost minus the accumulated depreciation for $44,875. I'm going to have you do all of these lines for X2, 3, 4, 5, and 6. For X6, you might run into a little bit of a problem. I've given you a thorough note about that problem down here. So I'm going to leave this schedule up. I'm going to have you go ahead and do the calculations for all the years. And pause your video, come back and check your work when you've finished. Thank you. So now that you've finished the schedule, you should have come up with a maximum depreciation expense throughout the entire life of the asset of $48,000. That's cost minus salvage value. Therefore, accumulated depreciation at the end of X6 should have been $48,000, and book value should have been $5,000 at the end of X6. Remember, you can never depreciate the salvage value. The trick in figuring out X6 depreciation expense is to realize that you're getting very close to the maximum. So down here we calculated the maximum amount that we can claim after X5. And that's $5,300, the $48,000 maximum minus the $42,700 already claimed through X5. So if actual depreciation for 20X6 was less than $5,300, then we would claim the actual amount of depreciation for X6 and take our depreciation calculations into X7. However, the actual depreciation for X6 was $5,575 in this calculation, so depreciation in X6 is limited to $5,300. Well, that's all for this video. When we come back, we'll start talking about another depreciation method, double declining balance.